Return heading Modi Gilani middle approach. In bracket write down MM approach. In that write down assumptions. Let us see the next theory that we have, that is called the MM approach, Modi Gilani middle approach, and in that again I'm starting with say the certain assumptions say, which have been made. Everybody is requested to pay attention. First of all, having a discussion, then I'll make you proper note for this. The first assumption is that capital market is perfect. It means that so the information is available to all investors in equal proportion. So there is no underpricing or overpricing of the security, and all investors are rational. Investors want to increase the return and decreasing the risk. That is what we understand. So no investor is making any investor with any sentiments. Second, there is no income tax or capital gain tax, and if it is there, then in that case so both of them are same. In a way that so there is no tax or there is no tax discrimination. Because of this, what will happen importantly, friends? So the investors will be indifferent whether investor is getting return in form of dividend income or investor is getting the return in form of the capital gain. Third assumption, fixed investment policy. This is very important. The assumption is made that over here that the companies are going to have the same investment policy irrespective of the payment of equity dividend. Let us say for example, so the earning of the company, profit of the company is, let us say 50 lakhs, and the company is going to expand its business by an amount of 75 lakhs. So if at all that entire 50 lakhs is paid in form of dividend and the retained earning is zero, then we'll make the new issue of 75 lakhs. Entire 50 lakhs is retained, we'll make the new issue of 25 lakhs. In a way that say we are going to expand our business unconditionally irrespective of the payment of equity dividend. That is what the kind of assumption is made. Practically what happens, friends, that the number of times this assumption is not true. Practically number of times the companies think about the expansion only if at all it is having the retained earning. But they have made assumption that say no, we'll make assumption that the irrespective of the payment of the equity dividend, the investments are going to be made. That is assumption which has been made. Fourth, very simple, there is no flotation cost, there is no transaction cost. Fifth assumption that they have made is that say all investors are able to make a forecasting say about the price of equity share, about the dividend, in a way that say the earning, whatever the like the futuristic of the company, say for that say the prediction can be easily made say by investors, and say all the investors are having say the same discounting rate. That is the kind of assumption which has been made. So write on heading assumptions of Modi-Gilani mirror approach. In that write on first, there is only equity finance. Second, rate of earning of the company, in bracket write down R, comma, I'm sorry, second assumption is capital market is perfect, comma, it means information about all securities are available to all investors, and all investors are rational. Full stop. No investor is taking any decision based on non-financial factor. Full stop. Investments are made to maximize return and to minimize risk. Third, there is no tax or there is no tax discrimination between capital gain and dividend income. Fourth, there is no flotation cost, comma, transaction cost. Fifth, importantly, it is assumed that investment policy of the company will remain same irrespective of payment of equity dividend. Full stop. Sixth, it is assumed that an investor can properly forecast dividend income, comma, future price, and there is a single discounting rate for all securities. Full stop. With paragraph read down, as there is no tax or tax discrimination, comma, investor is indifferent between dividend income and capital gain income. Full stop. So, next question. Consider following information. An investor purchased a security in form of equity share at the rate of 600. He received a dividend of rupees 10 at the end of the year. Further, market price of the equity share at the end of the year is 650. The question says that to calculate the return to investor for holding the security for 1 year. That is a question. Friends, what kind of conclusion is drawn by approach? I'll just explain that to you in like the subsequent question. But before that, I want to do some numericals by applying the common sense. Okay, not something like the great fundamental formulas. By using some common sense, we are going to make some calculations. As a part of this question we are solving, I request all of you to give answer for this question in the chat box. So friends, over here, let us have understanding how to make the calculation of answer. An investor purchased a security at 600 and technically we know it is P0. Dividend is rupees 10 and the price of the equity share is provided as 650. So we understand that's the 10 rupees of the dividend plus 52 pieces of the price change. Okay, that is a positive price change divided by 600. The price at which the security was purchased and overall return is 10%. That is the way the return of 10% can be found. So please write an answer. Calculation of return to investor. Friends, return to investor can be calculated like this. D1 plus P1 minus P0 whole divided by P0 into 100 for getting answer in percentage term. What is D1? D1 is rupees 10. What is P1? P1 is 650 minus 600 whole divided by 600 into 100 for getting answer in percentage term. This is the way the return can be found. So 50 plus 10, that is 60 rupees upon 600 into 100, that comes to 10%. This is the way the return can be calculated.